Hi, I'm Roger Conrad. I'm here at the Orlando Money Show with my longtime friend and colleague Elliot Gu, and we're presenting on energy. Pretty much all aspects of it. We had a short presentation where we talked about some big themes earlier this morning. I just did a presentation on electricity, and Elliot was on a panel as well talking about energy, some of the broader themes. And tomorrow we have a big presentation on energy, an exhaustive one, which I think will exhaust us. But I think a lot of good, hopefully to give a lot of very good insights here. A couple things I want to talk about during that presentation. One big theme is Midstream. Now I guess I'm known for writing about pipeline stocks. I have for a number of years, recommended a bunch of them, own a bunch of them myself. It's been a group that has, if you bought the right ones, has generally made money over the years, over the decades. We had the last part of the last decade, the last 5 years or so, starting about 2015, a lot of downside in the group, but the last 4 or 5 years, it's been pretty good. We've made a lot of money in some of the names that we have liked for a long time, names like Energy Transfer, Kinder Morgan, and so on. But what's happened this year is it appears that a lot of people are thinking that 2025 is actually going to wind up being a lot like 2015. So 2015 was the year when the bear market in energy began in the previous decade, and it didn't really bottom until mid part of 2020. But since then, things have been going well, like I said. And now I guess people are thinking, or some people are thinking, yeah, that's the end of the road. Now, these stocks have been underperformers this year. If you look at the Alerian MLP index, it's pretty flat for the year. So you compare that, and of course, there's a lot of FOMO going on right now, fear of missing out. And a lot of people have been investing in technology stocks. They're looking at the S&P 500, which is 37% in just 8 names, which is kind of amazing. Oil and gas total is less than 3% of the S&P 500. So it's historically underweighted, even as big tech is historically overweighted. And people, I guess, are looking at these stocks, but there are a lot of differences between now and 2015, and I'll just mention some of those. And it really do make all the difference. One, these companies, there are far fewer of them. There's been a dramatic consolidation, over 100 different mergers, acquisitions, and so on. So right now you have probably about 8 companies, midstream companies in North America that actually matter, that actually transport meaningful amounts of energy. Huge difference from where we were in 2015. So big companies in this industry, it's very capital intensive. They tend to do better because they can take a punch. But in addition to that, we've had 10 years of basically debt reduction. Companies have been very, very conservative in terms of new capital spending, even in terms of dividend growth. They've held back on all these areas to strengthen their balance sheets. So coming into a period here, maybe of a little bit weaker oil and gas prices, these companies are as strong as they've been at any time in their history. I mean, they're bigger, they're stronger, the balance sheets are stronger, and that makes a big difference in terms of what might happen in ensuring that there's not going to be another, that 2025 will not be another 2015. So, and then finally, and a huge point here is that we're in definitely a growth area for natural gas in this country. Natural gas has been the primary, is right now the primary source of primary energy in terms of generating electricity. In other words, far bigger than anything else out there. Nuclear, coal, over 40% of U.S. electricity now generated by natural gas. Now, why is that the case? Well, because it's cheap and it's plentiful, and you can build natural gas capacity pretty quickly. That's a huge area of demand, particularly now that artificial intelligence is sucking down so much power in data centers. particularly now that reshoring of manufacturing is increasing the demand for electricity. Even a demand for electrified transportation or electrification of industries, population growth, all these things are driving usage of natural gas. Now, for midstream companies, that's a huge source of growth because as they invest, as volumes increase, earnings, dividends, they rise in tandem with that. So big differences in the midstream sector between now and 2015. I think the correction that we've seen in some of these stocks is a tremendous buying opportunity. And I've been talking about some of these names. Some of them are yielding as much as pretty close to 10%. So you've got companies in an industry that's growing, that's essential, that yield 10% or more and are growing those dividends at a rate faster than the rate of inflation. So very, very bullish here. And these are the types of things that we're writing about in the Energy Bulletin. And I'd like to invite all of you to check it out by checking on clicking on the box there and for one of our no risk offers. In other words, we let you kick the tires. You can see if you like it or not, but we really do invite you to check it out. Thank you for listening and happy investing.